everyone. Thank you so much for joining. In this video, I would like to give you an idea how to measure the performance of an investment fund. As a general rule, the best way to start measuring such an investment is with IRR, because it takes into account the respective cash flows and the timing. So that's, as you know, IRR. I do another video on IRR, or I think I have done one already. So the internal rate of return provides a good starting point for providing you the internal rate of return of this investment based on cash inflows and cash outflows. Second alternative, which is a shortcut, it's not as accurate because it does not take into account the timing of cash flows, is so-called MOIC, which is the multiple of invested capital. And the formula is realized value of investment plus unrealized value of investment divided by total amount of invested capital. Okay, realized value. What is realized value? Realized value is the total proceeds or cash generated from the investment have been sold or exited, whereas unrealized means if this part of the investment still sits in the portfolio, has not been sold, not been exited. However, you still need to take this into account because in the end, after you exit at a later point, it is still available for distribution. So you take in what was generated. So the numerator is your output. Your denominator is your input. So you get basically your figure is TBDX. Total amount of invested capital, very important. This is paid in capital. So what all the limited partners and the GP have put in initially, minus management fees and any other fund expenses. Very important. So total amount of invested capital excludes management fees and fund expenses. Let's do an example. Let's look at the calculation example. So how to use it? For IRR, so IRR formula, you are familiar. NPV equals 0. Sum of all cash flows per period, 1 plus R. And then if you solve it for 0, then your R equals your IRR. That's what we want to solve for. So let's assume we have an example. Let's assume in year 0, all the investors put in 2.5 million. Let's say in year 1, they put in additional 1 million. Let's say in year 4, they put in additional 500,000. And let's say in 10 years, they have exited for 9. Yeah. So if we use our MOIC, what we do is, this is what we have put in, this is what we have put out. So output 9, and here we don't know whether it's unrealized or realized, but that's what we have received and what we are able to distribute. And then what we have put in is 2.5 plus 1 plus 0.5, which is 4. So you have 9 over 4 equals 2.25x. So this is your multiple. It's not as accurate because it doesn't tell you about the timing. Here it looks like you have received more than double what you have put in, which sounds great, but if it takes you 100 years, it's quite long. Yeah, so here MOIC, multiple of invested capital, does not solve for or does not take timing into consideration. That's why IRR is a better indicator. If we would use IRR and we would type this into the calculator or in Excel, then we would get out 9.09%. This is the return, internal rate of return of this cash flow pattern. So when you think about IRR, always think about that's the return when looking at this cash flow pattern. It's not subjective, has nothing to do with investor preference. IRR looks at the cash flow pattern very neutrally, looks at in which year do you have cash inflows, in which years do you have cash outflows, and based on the cash flow pattern, it gives you a return. Yeah, so this is what you do for investment funds. There are for sure additional complexities based on how the fee structure, how the fees, management fees, performance fees, and fund expenses are structured, which I will explain in another video. Also, once we include using debt and working with leverage, then there are some additional complexities as well, which I will cover in another video. Thanks so much for joining again. I hope you found this useful, and I see you in another video. Bye bye.